we have given 35 minutes, and the subject is very, very huge. Perhaps we may not justify, so we can take some questions, which I've already noted down. But before I start and to go to the panelist, I will tell you one story where they were talking about Indian tax structures. I was the part of Piyush Goyal travel to Germany and France, and we were talking to the businessman, local businessman, and everybody was asking that Indian tax structure is improving, but there are miles to go. Because there is, if you see, many of you would have gone to Thailand, Singapore, and if you see the entire tax book of that countries are just in one book, right? We are too far of that. And when the things become very complicated, compliances also become very complicated. It is a related subject. We have heard Pramod ji has given a kind of background already, but on the cost of repetition, I will say that the tax environment particularly become very complicated in the view that we are talking a lot frequent about artificial intelligence, the vigilance, the forensics, etc., etc. But then there are a lot of new regulations which are also on the horizon. So, without wasting any further time, I would start with Alok. So, Alok, in the context which we have discussed since morning today, how can tax leaders reposition themselves from compliance sales managers to business enablers in front of the board? What is your thought on this?
Thanks, Abani. The bottle is actually sealed right now. Otherwise, I would have first taken some gulp of water because we are talking about the board. So the times have really changed right now. If I look at the start of my career when it was more than 15, 16 years back, it was more of compliance driven. The tax used to be more of compliance driven. I have experienced it myself. The time what I'm experiencing it right now is we are at the forefront because board is at the forefront. So the tax leader or the tax team are a kind of in-house advisors for the board. Why so? Why I'm saying so? You are entering into a business transaction. What is most important for you? Revenue, which your sales team is going to get it for you, and cost, a huge laundry list. If you look at other elements of cost, all the cost elements are kind of, you can foresee them. It can be budgeted. Of course, you can budget the tax cost also. But when we talk about India, I'm sorry, I'm not getting against Indian revenue system at all. But when we talk about India, tax is too litigative. The tax rate is 25% to 40% depending on the company, like domestic company or the foreign company or how the transaction is. But this is not end of the road. You may factor into 40% of the cost, but because of the litigation, because of certain views and positions, it may scale up more. So the board or the business teams look at the tax team before initiation of any unique nature of transaction, that is a new transaction. They come to us, they seek our views, what best and how best you can structure it so that we can foresee the tax cost onto it. Of course, we'll foresee the litigation costs also onto it. And then the board can look into how much profitable the transaction is. And they can have a, peaceful night's sleep, at least from the tax front, because other costs are also quite manageable. So this is how the tax people are, in a sense, upfrontly working with the board to structure the transaction at the initiation stage itself.
Thank you, Alok. Yeah. So I would come if I would have some time left back on that, but I will go to Pushpendra to have further questions on my right. So Pushpendra, it would be great idea on top of what Alok has already mentioned. So beyond effective tax rates and liability forecast, what are the non-financial data points like ESG? So we have talked about litigation success, reputation risk, etc. that you now bring to the board. How did a recent event in the various cases decided by the various courts changes what the board considered material from tax?
Good morning, everyone.
And by the way, I just a round of applause for Pushpendra. He is just finishing writing a book on tax subject. So,
thank you. So I think it's a good question. And first of all, kudos to the government for unprecedented investment in technologies. I mean, industry is, catching up because government is way ahead in terms of the technology, be it income tax, be it GST. Look at the beauty, the way, sites and things are working. And my, comments are more so with respect to the future. Uh, we just heard sir about transaction taxes he talked about, but the fact is in time to come, each transaction is going to be under scanner, and the best way to do that through right technology. And if we take care of that transaction level right from the beginning, we can easily sail through, be it the board, be it the revenue authorities, or be it the cross border thing, because we are really living in a borderless world. So a lot of things which are in the offing, like OECD Pillar 1, Pillar 2, we spoke about. A lot of people are knowing about it, and we will definitely, take a plunge in practice also, because it is not yet operational full plunge. But the indication is clear. We are living in a borderless world, and we need to only have one truth. That truth continues all across. That's the way we will be able to survive. We will be able to have good revenue audit closure, and we will be able to, convince the board also about the proposed transactions quickly. Like if I am aligned with OECD Pillar 2 approach, which says minimum taxation across the globe wherever we plan. So businessman is now clear that we need to end up paying 15% tax regardless of the place I am going to operate. I have to that ESG mapped to that, right allocation, transfer pricing, everything has to be, well aligned with that, well attuned with that. And then I think we can really look forward to.
Thank you, Pushpendra. So I'm coming back to Neha. So Neha, we just heard panel views on how tax may influence on our business decisions. Let's talk about tax, transfer pricing provisions that generally runs into the litigations. What signals tell you that the transfer pricing position should be escalated to the board for redesign rather than continued defense?
Thank you, Abani, thanks, Abani, for the question. And I'm glad to be here. Thank you for inviting me here. And Business World, same as well. So Abani, your question, what triggers all of this? And this is something which uh, is coming from the uncertainty that flows around in case of the tax positions that they take, the transfer pricing positions they take. Now, looking at the key triggers, I think what for a tax leader, the triggers can be from the recent assessment data that goes into public. Watch out for those data. Look at the positions that you have taken, sensitive positions, safe positions. It is not only an year-end exercise anymore. You know, we are there on the board with the finance teams, with everybody. So it's not only a compliance function as of now. It is you enable the business at some point in time. So review your positions and see where the anomalies are, where the the documentation is lacking, where the gaps are. So that becomes a key trigger. And last but not the least, what I see happening around is if if you see a consistent position being challenged every year, say for example, say an auto industry, there are distributors, there are royalty payments, which are some key aspects of any manufacturing, and these are some cases which are prone to litigation. So take those assessment data, take those positions that come into the market, take the ITAT decisions and everything as a basis for evaluating where your positions are, and see if there is something which is triggered there. So I think all of these points that you evaluate on your own, first looking at the positions that the tax authorities are taking, looking at your own data, not only at the year end, but during the year, as and when you do the changes in the business. And also, the third thing is looking at certain positions that have been taken on an aggressive basis, which can enhance your uncertain positions. So all of this, I think, becomes the key triggers which you can take as a tax leader to the board.
Yeah, I won't leave you that easily. So my question was largely around that when, as a tax head in our organization, you decide that now this is the time, related to transfer pricing or litigations. Now it is a good time to get update to the board or give them the appropriate information that this is a kind of recurring, incurring all the time, and we should take change in the position. I mean, you can't be specific or just kind of ballpark idea.
Right. See, it again, as I said, it is not an year end exercise. The triggers will not only arise at the year end. So when you go to the board, I think, say, just as a high level example, look at a quarterly analysis of the data. Review your positions on a very regular basis. Say quarterly is a good regular mechanism, and then see that the gaps that you find in the data arising out of any kind of situation. For example, you've taken on a new business. Do you have a sufficient documentation in place? Do you have the rationale which is built into both in substance as well as in form? So those are the things that you keep evaluating. If this triggers something, go back to the board.
Sure.
Say, we are not stopping you from business, but we are trying to enable that you do the business in the right way and you have the positions in place so that you're not litigated down the road.
Sure. Thank you. Thank you. So I would now like to go to Chandan. So Chandan, if you can tell me about India now has green credit program, right? Can you give a practical example of how the tax function is evaluating a potential investment, not just on ROI, but on eligibility for these new age incentives and its impact on the company's overall ESG tax position?
This green environment, as what we commonly understand in a situation, is like you're a tax person and you are supposed to do tax compliance in industry, and you are saying about green tax. The first thing comes in mind: is there any provision in law which says in income tax about green tax? So, is there any codification by government which allows you an incentive if you were to comply with certain green? So, what is green is that the world is facing from a high carbon in the environment, and so you need to decarbonize. So, what are the policies which government has come up, whether they are incentivizing or disincentivizing? So, those policies you are checking on, and whether there is a relevant tax law, whether it's income tax, GST, or be it any other law, you might need to import equipment also, so that your company's carbon into the air it reduces. So are there any laws in India to say about this? Is there any synchronization? So what it came to us in Dabur Group, like, this ESG, like we implemented in 2022. And I was just wondering whether this ESG has any advantage to me. Does Government of India warrants ESG? Is there any statutory law on ESG in India? I found there's no answer to this. Why company does ESG is only because it improves their global rating. So they are FIIs who are investing in your companies. You need to say, look, I am ESG compliant. I don't also, before that ESG, I don't employ any child labor. So that's a good global policy. Now, similarly, ESG, environment, social, and governance. Now, that's a very important thing. That, okay, you're protecting environment by not releasing carbon into the air. So what steps you did? So there are a whole list of questions. Now, there are agencies. In India, currently, there is no agency who does a ESG accreditation. These are all global companies who does ESG accreditation. So you need to engage, work with them, and they will come up with a host questions. They'll go to your factories. They'll study the norms. There are raw materials which you cannot use at all. They are banned because they are poisonous to the environment. And so in this way, you work with those teams. So there is an increased cost of business when you are ESG compliant. On a tax side, ESG just offer 2%. So on a scale of 100, tax contribution is just 2 to 4% on ESG. That, look, Pillar 2 says minimum tax is 15%. So if you are above 15, you are safe enough on a ESG that, okay, you have met some goals. And second, you're not operating through any tax havens. That's another requirement under ESG. So when you are on a global tax rate of above 15, let's say you're 18, 19, you're not operating through Cayman Islands and the tax havens of the world, you get a fair rating on ESG on tax side. I was just wondering whether there is a universal, so in the ESG, there is no universal tax rate. Like Pillar 2, we say 15, but in ESG, they have not mentioned any tax rate. So it goes more by the local laws. So that was on the ESG, but I'm a company like let's say, releasing more carbon in the air. Now, what I do to get rid of this and to minimize, I buy a carbon credit from other companies. People who are, they have got points on the that they have released lesser carbon in the air. So I buy those credits. So the company which sells the carbon to the other company, their tax rate in India is subject to 10% only. And on that 10%, they will be not allowed any deduction. So government is doing some bit, I would say. Pollution, environment is still a big concern. Income tax, as of now, apart from this 10% tax, has nothing much to offer. I think it's a long journey. Every year when I review my tax return for the company, for the group, I always see like what attempt the Dabur group took to lower their carbon release into the air. And each time the question comes to me, oh, this year I released this much carbon, I brought down this much lower plastics, lower carbon, but there's no incentive to it. So there has to be an incentive program. I think government need to work on this to say that, okay, we need to be environmentally friendly. These need not be just in words. It needs to be put in action by policy. So that's what my say on the green tax in India.
No, thank you, Chandan. So, kind of related question, Chandrika. So, we have seen since morning people are talking about Pillar 2 and multiple times. So, what is the single biggest gap you see in Indian headquartered M&Es today? Is it data system, skill set, or interpretation?
I think all of them, because pillar 1 was complex. Pillar 2 is going to be a bigger challenge, for implementation, because the way it has been designed and structured, it is very complex. And the challenges that are there is, first of all, India doesn't have a legislation as of now. So what the MNEs, India headquarter MNEs currently are doing, they are playing a catch up. So wherever the it has been implemented elsewhere in the world, they will have to comply, because Pillar 2 works on common approach. So if you do not have any laws enacted in your local jurisdiction, you have to go with the flow, what other jurisdictions are doing. So you have to do all those calculations, and you have to prepare yourself. So the first challenge is the complexity in calculation of the top-up tax. Then the concept that how you will pay these top-up taxes is the first is QDMTT. So your local jurisdiction has to have that enactment that wherever the tax is less than 15% ETR, so you have the right to recover it. The second rule is, if you don't have, your parent entity will have to recover through the IIR. The third leftover is UTPR. So the entire mechanism as such is very complicated. Then last but not the least is, in MLIs you will soon have the STTR, subject to tax rule. So how you will calculate finally and how you will close the calculation is very complex. Then you need all the technology to do all this, to capture what is happening in all the jurisdictions where an M&E functions. Then determination of the set-offs, where you are paying QDMTT, how you are setting off. Then you have to examine whether you fall under any of the safe harbor rules if your jurisdiction enacts it. Now for India, typically we have MAT. So MAT, it is not even qualifying as a credit there. So basically the government has to now look for shifting the MAT or any other incentives that we have, which is making the ETR lesser than 15%. So they have to look at, giving you more incentives in terms of subsidies, in terms of capital infrastructure, in terms of, labor that you are employing locally. So all these are the challenges that I see, that India needs to be geared up, and elsewhere in the world also. Because many territories have also started the registrations and implementations and all that. But I think India is not bothered, because one, we have very high taxes locally. And then a cost benefit has to be done. So if you are implementing in all these three, IR, UTPR, so it comes with a cost. You have to train your own people. in the tax government also, they have to train and they have to come out with a specialized team who understands it and who will actually see how to implement once the law is there. So I think that's why, we just, Indian government is just waiting and watching, because maybe they don't see much merit in, getting into all these complexities, and ultimately how much are they getting out of it?
Thank you. Thank you, Chandrika. So, my government is listening. They are in this room also. So there will some communication will happen back to Mr. Mrs. Nirmala Sitharaman. So I come to my good friend Rajesh now. What is this buzz about strategic restructuring figure? Right. We have seen Indian tech and pharma giants re-domicile for a large Indian M&E. Do you think it would need to review the holding structure under Pillar 2? Also, how do you foresee the geopolitical situations playing out on Pillar 2 implementation?
Thank you, Mr. Jha, for your question, and good morning, everyone. Of course, the whole world is talking about Pillar 1 and Pillar 2, and for many countries that has already seen the light of the day. The laws have been enacted in those jurisdictions, barring a few. When it comes to reviewing the holding structure of the companies, of course, there have been time in last decades where the focus was more on tax haven selection of countries for IP sort of things. Your patents are lying in those countries where tax is practically nil or at a very low level. Then there were certain finance companies also, which were choosing such jurisdictions to earn money in those jurisdictions and paying practically no or low level of taxes. But now Pillar 2 coming in, probably, the law remains that 15% tax has to be ensured at the group level. And of course, it needs to be reviewed jurisdiction by jurisdiction. That is what the law says. Now, if I talk about a group, probably, which would have established the IP companies in low tax jurisdictions, the real question now is it really required for that group to continue holding that way? Or really the subsidiary relationship needs to be changed? It needs to be moved to those jurisdictions which probably are good in terms of the reputation, business-friendly environment, labor laws, and more strong regulatory environment. So this is one aspect. Probably I'm of the strong belief that organizations will start thinking about all those things. If I talk about India as a country has not in a big way talked about implementation of the Pillar 2. Of course, indications are around because many Indian companies which are headquarters in India, they operate at a global level, and more we can see on the IT side. And of course, there are other sectors also where the companies just go do different jurisdictions. So those companies have already started doing it because if India is not has not implemented Pillar 2 as of now, but yes, on the other side, there are a lot of other jurisdictions already implemented. So, for example, if you see the notification of 30th of August 2025 issued by MCA, the accounting standards are being revised just to give a momentum to the disclosure requirement. If you are a company who may be paying taxes 15% in other jurisdictions, you need to disclose it here in terms of whether you pay it QD, MTT, or whatever name you pay it by. So those things will come in. Your second question of geopolitical situations, we can talk about or think of one country, probably not difficult for me to name. But yes, if the big countries are not becoming party to Pillar 2 for the time being, does it stop the way? To me, it seems practically no. But yes, there may be bottlenecks to the whole processes here also because, if such a bigger economies are not falling in the mainframe, probably will not yield the purpose for which the Pillar 2 was all thought about. So I'm hopeful that all the jurisdictions, the bigger one, will also come into the mainframe.
So thank you, Rajesh. We are in round 2. I would request panelists to have a short answer so that we can cover round 2 also. And in this, I will come back to Chandan because we are talking Pillar 2. So Chandan, I just wanted, and for everybody's consumption, implementing Pillar 2 require data from finance, legal structure, from corporate law, and interpretation from tax. Can you describe a specific friction point where alignment between these three functions broke down and how it was resolved?
See, we are an Indian headquartered company, meaning we have gone out of India, and so we are an outbound company in that sense, and we need to globally deal with Pillar 2 regulations. And as we see Pillar 2, like India as clearly is not on Pillar 2 as of now, similar to US and China. So these are three major economies where the trade is done. Only Europe, to a large extent, is on Pillar 2, and some African countries. So there's a lukewarm response globally on Pillar 2. Now, when you say Pillar 2, like the first question which came to our mind, like we are operating out of 32 locations abroad. In which of these locations my tax rate is below 15%, where I do substantial business, or I accrue profits, or I have assets? Now, if my answer is, let's say I'm 15% across these 32 locations, then I need not worry on Pillar 2 at all.
Yeah.
This is a mere compliance tool then. And so, because locally you're on 15% tax, like let's say, for example, UAE is a global tax, UAE is a tax rate of 9%, but recently they topped up with 6% more, QDMTT, making it to 15. Now this tax, what it means is 15. So I need not worry on UAE at all. But let's say I'm working on, I have business operations out of British Virgin Island, BVI, Cayman Island, or Isle of Man. These are tax havens with nil rate, though they are also coming up with Pillar 2 rates. So there's no pass by there also. There's no green channel as such, because out of 200 countries in the world, 140 has promised to implement Pillar 2.
Yeah.
That's a quite sizable number. Meaning to say that 15% is a threshold global rate, akin to some sort of a custom rate. Threshold is 10%. So here the tax rate is 15. Now, for us, the difficulty was that, as a company, as a headquartered company, how do I figure out my cost actually? Because, you need to put resources actually, or either internal or external. So there's a cost involved in relation to Pillar 2. For people sitting in this room, the first Pillar 2 report has to go out by 30th September 2026. So any company in the world, they need to send a GIR report by 30th September 2026. That's the first requirement on Pillar 2. So we are out of India. We are not on Pillar 2 India, but let's say in UK, UAE, and there are 10, 12 locations more where I need to file that report. And where that report will be filed, we do not know. Whether it will be filed in India or to where my subsidiaries are. So it's a moving thing actually in that sense. Now, as far as the data collation in Pillar 2 is concerned, this Pillar 2 is more based on book concept, not on tax. Because tax can vary nation to nation, but a book concept means your accounts are drawn as per IFRS, which is a globally recognized accounting standard. So there is a similarity and the standardization. So more or less the treatment of expense, income and expense is more or less same actually. Deferred credits or same, there are some nuances around that. So to source the data from across the geography, foreign exchange differences, to classify on 31st March, what would happen to those differences, deferred tax credits, some of the entries, subsidies might be in losses, and how do you offset that in relation to a particular territory? So there are differences actually. One can go into nitty-gritties, but by and large, if you are above 15%, you are safe.
Okay.
But let's say the tax rate of a country is 12%. The question comes, are you Pillar 2 compliant? Now, Pillar 2 has given a carve-out for the first 3 years. They are called safe harbors. So even if you are lower than 15 to 12, and if you happen to engage certain more manpower in that country, or you engage more fixed assets, so you get a concession actually. That concession can range from 1 to 3%. So despite being 12, you are still compliant with Pillar 2. So that all need to factor all these, and it's an interesting learning. And as a tax person sitting in India, we learn about how different geographies work around. You become more familiar with the business across the world. So the learning goes up. And if a person sitting in India, his learnings goes up, the tax department would be also in position to similarly scale up their learnings.
Thank you. Thank you, Chandan. I'm running out of time, but I have a very interesting question for all the participants in the room. I'm going back to Neha. Now, Neha, you have seen since morning that tax departments are very proactive on the adopting technologies, AL, ML, artificial intelligence, forensic science, etc., etc. So, how can corporate reverse engineer this?
Well, I think reverse engineering is quite a negative word. I would say learn from it. Learn from it. Use the same lens. Use the same technology. And even before the tax authorities pick it up for you, you pick it up for yourself. I think a better defense is much better than a litigative position. So I think this is how. For example, say again, I will continue with my example of an auto industry because I come from there. So say for example, you have a management charge coming in every year. Right now, we know in the Indian tax landscape, it is a very highly litigative position. So, do you want to want tax authorities to pick it up, or you want to prepare yourself before even you file the return? Do you want to see what kind of benefit documentation that I have that justifies these charges before a notice is issued to you? Having 10 those standard questions, which is pardon this, goes to every taxpayer. Do you want to prepare yourself? I think that is where this is just one example how you can reverse engineering it. Maybe I would say learn from it and use the same lens to see the data.
Thank you. Thank you. Chandrika, one of the questions from GST also. So taking GST litigation as one area, beyond robust documentation, what is one unconventional proactive step a company can take today to reduce future exposure on litigations in GST?
I don't think any.
Okay.
I don't think any, because the fact that the government has launched more than, I think, 800 notifications since the law came, GST. So it is ever evolving. So I don't think you can actually
agreement with
you can actually come out with a non-conventional idea or out of the box thinking to avoid GST litigation. Number one. Number two, I don't know why advanced rulings are always so negative. I don't know. So there is one enthusiastic company who wants to understand how much tax you want to pay. I don't know why the rulings that you get, they are so discouraging that you don't even think of approaching them that how much tax I should pay. So in GST, the only way you can predetermine is go for an advanced ruling. Or the other way is make a representation to the all-powerful GST Council, who is running all the show around GST. So I think that's
but
the other way.
then Sir have said that people are not no longer seeing the kind of 20 pages well articulated legal documentation, but they refer the WhatsApp and all those discussions. So you cannot avoid those. So tax authority have means to unearth that also. So Pushpendra, just one question from your side, and if you can be quick. The globe rules have complex safe harbors and substance-based carve-outs. In your experience, is the current strategy for Indian groups to aim for qualification under this, or to accept a top-up tax and focus on operational simplicity? What is the real life dilemma in from this view?
So you are saying outbound for Indian headquartered was moving out and more from pillar 2 standpoint. I think a lot Chandan has mentioned about it, but I will just accentuate or emphasize on the fact this pillar 1, pillar 2 was much awaited. Good that OECD has brought in, because if we don't have these kind of things, we will not be able to move. We will have only unilateral tax measures being adopted by different countries, and we'll have push and pull. Good that there is a sum system, and good that for the first time OECD has accepted India's approach of accrual based taxation. They were always harping about residence based taxation, all developed countries. For the first time, OECD through pillar 1, pillar 2, they accepted, rather pillar 1 specifically, that income has to be taxed based on accrual, but income and efforts and return. Coming to the point which you mentioned, India is already, having more than 15% tax, except those cases where companies are availing SEZ benefit or some other, left out incentivization, because government of India is clear. We need to align with the global standard. We need not to give more and more tax incentive. We need to give other than tax incentives to make ease of doing business, etc. So nobody is bothered about going below 15. People are bothered about the clarity, the certainty about the law. That is more than warranted for good taxpayers, good companies who are listed and who want to who want to make their presence felt globally. So they are really concerned about right compliance, follow the law, but they need certainty.
Thank you. One last question from, I will take 1 minute extra. So to Alok, one of the very famous court case in India is the Vodafone case. But I have a bit different question here. For a company like, say, about 50 ongoing litigations, how do you objectively decide what to handle with in a house war room versus a specialist counsel? What factor, cost, control, strategic, secrecy, or most decisive in your experience?
Bandwidth, I think, most important factor.
Yeah.
So everyone in industry who is working, we are working like most of the teams are working on a very lean tax team. And so the priorities are compliance, managing or supporting the business folks, and of course, responding to the notices which keep on coming. So it all depends on how much time do we have, what is the gravity of the notice. If it's too technical, too in-depth, which requires some kind of expertise, then I think we or someone should engage an expert consultant, expert counsel onto it. If it's something which is recurring in nature, which and the tax team is having some bandwidth as well, so we can ourselves go and represent before the tax authorities.
Okay. Thank
Chandan
you.
might differ on this view.
Yeah. Thank you. One last question to Rajesh. These days, high-profile tax disputes is no longer just a legal issue. It's a media and investor relationship issue. Beyond winning in a court, what should be the tax function's role in managing the narrative? What is your take amid the recent developments where tax become a talk of the town?
Sure. I'll put it in simple words. Whenever you win any particular matter, don't be that euphoric. Just go with the flow. And more importantly, what is really required, and just speaking to external world, you just speak internal world also. For example, your own employees. In case you believe that particular litigation which is high in volume and complex one can bother the employees in-house, because employees most of the time have a lot of questions. What about the company's future? So you need to sit with them, just tell them the things will be all right, and whatever will be the outcome, it should be acceptable to each one of us. Sometimes the purposeful non-action can be a good policy, because you just sit quiet, let it pass on. And of course, we have huge amount of laws, legacy in this country, and beautiful courts sitting across the country. So they are there to interpret the law, and whatever decisions are, live with it, speak to your partners, management, employees, as I said. And to the external world, you may choose not to speak, because purposeful non-action can be a good policy and strategy.
Thank you. I practically experienced this. In my previous IPO, this is my third IPO. In previous IPO as a CFO, I was, about to file my DRHP, and the Director of Revenue Intelligence came to clarify some custom related matters which they are not entitled to. That is not their domain, but they have came and everybody was talking ki DRHP file hoga ki nahi hoga. Now all these uncertainty actually creates a problem for the employees' mind. At a first, it goes media and it may not go to the media, but generally it creates a lot of problem. So I am done with my questions, sir. If you have any question to any of the panelists, please speak.
Yeah, that's true. That's true. So, mhm.
So, question. I'm sorry, but you have a question? Okay. Okay. That's more of a pointer that you had.
It's a very good input.
And I agree for the GST notifications, you really have to open, once one notification and you have to open 10 another to establish the connect, with the latest notification. So
I think this keeps us
definitely agree with
employed.
you.
This keeps us employed. We should appreciate this.
Badhiya. Done. Thank you so much. Thank you, sir, for moderating that. Thank you to group pictures of all of you, please.